A very warm welcome to what has become probably an annual webinar for the newly promoted partners, or those at least aspiring to be partners in the next 12 to 18 months. And indeed, it is very warm, particularly here in sunny Essex. Go to the next slide, please. Hello, my name is Mark Waddilove, and I will be chairing this afternoon's event. I'm a tax partner at RSM, and I lead our London Professional Business Services team. Whilst unusually this is not a COVID-19 focused event, it obviously goes without saying there are a number of connected issues that cannot be ignored, namely postponed promotions and concern over the financial health and indeed security of your firm. I'm therefore delighted to introduce this afternoon's speakers to help you navigate yourself through the complexities and challenges and certain questions that you may be asking yourself. To kick off, we have Fergus Payne, a partner at Lewis Silkin, who is head of their partnerships and LLPs group. And he will be here to help lead us through your legal rights and duties, many of which will already be contained in the members agreement, which I'm sure you'll be asking for a copy of. Hywel Pegler, he is an audit partner and works with me on a number of mutual professional partnerships and has a passion, his words not mine, for profit and loss accounts and balance sheets. Hywel will be telling us what to look for in the firm's accounts, both financial and non-financial. We then have Ian Ratcliff, who's an associate director in my team, and he will be explaining, or should I say, simplifying the tax issues that you need to be considering and addressing as a new partner. And finally, Erlam of Brewin Dolphin, who will lead us with some thought-provoking questions on pensions, savings, and what your benefit packages may look like when transitioning from an employee to a partner. Now, we should have some time for some questions and answers at the end, so please do submit your questions through the various presentation tools. I think you should be able to see at the bottom, and there's a small functionality then, and submit them as we go. I will, at the end of the presentations, lead the questions and direct them to the most appropriate person. So, Fergus, over to you.
Thanks very much, Mark. Good afternoon, everybody. I'm Fergus Payne, partner at Lewis Silkin. I'm a lawyer who specialises in advising partnerships, in particular law firms, accountants, surveyors and architects, and a big part of my day job is drafting, reviewing partnership agreements, LLP membership agreements. I'm going to briefly look at sources of partners' rights and duties, talk a little bit about the members' agreement, then legal duties, legal rights, and finish off with a few words about termination and exit. So if we can move to the next slide, please. Right, just by way of a couple of introductory points, I'm going to use the term partner, but we're going to be talking about your role as LLP members. And from a legal perspective, my starting point is that you will no longer be an employee, you will be self-employed. And so just briefly looking at where all these rights and duties come from. We started back in 2000, some 20 years ago, with a very short piece of legislation, the Limited Liability Partnerships Act, by various regulations, certain other pieces of legislation, such as the Insolvency Act, Companies Act, now apply to LLPs and its members. Along the way, employment legislation become relevant, and there's a limited number of court cases that give us some guidance around rights and duties. But from a practical day-to-day perspective, you really need to be going to your LLP members agreement. It's made up. That's different names in your firm, partnership deed, LLP deed, and so on. But that's where your core rights and responsibilities are going to be set out. That may be augmented by partner's handbook or policies that hang off the principal deed. Clearly, my advice would be, as Mark says, request a copy, read it as best you can. Documents that kind of not necessarily that easy for lawyers to digest. Bear in mind, you probably won't be able to do anything to change it, but it's probably important to understand its content. And in fact, you'll be asked to sign a deed of adherence, agreeing to be bound by the terms, in which you may well be asked to acknowledge that you've read it and possibly understood it. So we'll move to the next slide, please, Ian. So the members' agreement itself, this is the source of your contractual duties and rights. As you'll no doubt be aware, firms often have different categories of partner, ranging from full equity to fixed share. Each of whom will have different rights and obligations. Core thing here is your remuneration will be moving from a salary to a profit share. Ian will be talking rather more about the implications of that later, in the context of being self-employed. Financial terms, always important, but as Mark has alluded to at the outset, these are challenging times for professional services firms trying to cope with the economic impact of COVID. Firms are looking at adjusting partner pay and so on to make sure that we can get through the next few months and so on. So it's an important time to be aware and to understand things like, is your fixed profit share guaranteed? Does the firm have power to reduce your monthly draw, the replacement for your salary? Is there a liability to repay any overdrawn current accounts at the end of the financial year? How are losses dealt with? Can those be allocated to fixed share partners, or is that just something for the full equity group? Is there any right for the firm to call on you to put in additional capital? The members' agreement will be the place that sets out your rights to financial information, which again will be very important in current times to understand how the firm's faring. And finally, the agreement will set out payment terms on any exit. So if we flick to the next slide, please. So in terms of legal duties, as an employee, you owe a duty of trust and confidence to your employer, which is reciprocated. Duty of good faith is owed by you, together with duty of fidelity to an employer. There's a slight switch, I'd suggest. Perhaps the bar gets raised higher, moving to a partner. You'll owe a duty of good faith, and this will be articulated expressly in the members' agreement, plus a fiduciary duty to the LLP on the basis that you will be an agent. That includes obligations in relation to avoiding conflicts, always acting in the best interest of the firm, and so on. Highly unlikely that there'll be any duty of good faith owed by the LLP to you, and as to whether or not there's any duty of good faith owing between fellow partners, again, that will be a matter for the members' agreement. Increasingly, that duty tends to be removed. And as I say, contractual duties, the kind of things you'd have had in your employment agreement, will be set out in the members' agreement. So if we can flip to the next slide, please. In terms of legal rights, both as an employee and as a partner, you're entitled to protection against whistleblowing. Again, the same when you move from employee to partner, you're protected against unlawful discrimination, grounds of race, sex, disability, and so on. Family rights don't survive the transition. Statutory rights to maternity leave and pay are rights attached to employees, but it would be very unusual not to have some equivalent rights within the membership agreement or its augmented policies. And I think I'd say that increasingly there's a move to try and make sure those are aligned with policies that apply to staff and that partners themselves aren't in any way prejudiced as a consequence. And you lose the right to statutory redundancy pay as a partner, and probably most important of all, as a partner, no longer an employee, you lose the right not to be unfairly dismissed, which is probably the most significant employment right that's being given up. So we can flick to the next slide, please. Right, just to finish off then on termination exit, probably the thing that's furthest from your minds at this stage, often confusingly referred to as retirement in a partnership context. Employees entitled to a statutory minimum notice period, although in truth, your employment contract may well have something that's longer. You're entitled to statement of reasons for dismissal as an employee, and bear in mind you're no doubt subject to certain restrictive covenants in your employment contract around non-solicitation of clients on dealing with clients, non-solicitation of employees, and will no doubt the express confidentiality obligations. In the context of partner, again, there's a whole series of important contractual terms that will be spelled out in the members' agreement. Your notice period, should you wish to leave, which may well be longer than in your previous employment contract. Bear in mind, some firms operate what's known as a waiting room or departure lounge, which is intended to limit the number of people leaving within any 1 year. Predictably, you can be asked to leave on no notice for cause, equivalent to summary dismissal in an employment context, and probably best to be very well aware of the fact that the firm can probably ask you to leave on notice without cause, commonly referred to as no-fault retirement or compulsory retirement, which is really the way that firms are able to move partners on the grounds of underperformance. This is where the removal of your right to be protected against unfair dismissal is important. Although having said all that, firms really do need to follow their own procedures and have a genuine and non-discriminatory rationale for asking a partner to leave to avoid any potential claims. You may find that you're subject to more onerous restrictive covenants, which might include a non-compete and probably more express restrictions around being involved in team moves. And finally, to say that the agreement will spell out terms in which you're entitled to take out any undrawn profit share and to repayment of capital. From many partners, capital will have been borrowed from a bank. So the important thing there is to ensure that what's in the members' agreement matches up with the bank loan you've taken in terms of the timing of any repayment. Right, that concludes the end of my section. Thanks for listening, and now I'll hand over to Hal to talk about accounting issues.
Thank you very much, Fergus, and a very good afternoon to you all. My name is Hywel Pegler, and as Mark kindly alluded to earlier in his introductory remarks, I'm an audit partner with a passion for profit and loss accounts and balance sheets. So look, happy to talk about these topics till I'm blue in the face, really, but I do just want to give you, I suppose, a snapshot and a whistle-stop tour of some of the key accounting issues, both in terms of the sort of statutory or LLP or partnership financials, as well as your own internal management accounts and what might be of interest to you there. And finally, just touching on your partnership situation, so your current account and your capital account before Ian takes that further. So that's the plan. So Ian, would you mind moving on to the next slide, please? So partnerships yearly accounts. Now, different firms have different structures. Some are old partnerships per se, some are LLPs. So typically what I'm talking about here really is the sort of LLP structure. And again, actually with my audit background, typically talking about larger, I suppose, LLPs, ones that are above that audit threshold of 10 million turnover, 6 million balance sheet and 50 employees. I think it's a really important distinction for you to all understand as coming into the firm as a new partner is what's the structure, what's the scope of the firm, and what assurance do you have as a partner when those financial statements are produced. It's important that you understand. As careers progress, you might even become involved in some capacity as part of an audit committee around the governance of the firm. So, as I said, important to understand what you are and what you're getting from your accountant there. Again, appreciating we've got a variety of probably financial and non-financial people on the call, so apologies to those who know a lot of this stuff already. But I did just want to broadly talk through the profit and loss account, which is effectively your measure of financial performance in any given year. You'll start at the top with turnover being fees billed plus or minus any movements in work in progress, which we'll come back to. And then typically you have 3 or 4 standard statutory headings such as staff costs, depreciation and other operating charges before you get to your final number, your profit. And again, one of the quirks that you might see on an LLP profit and loss account is a heading profit available for discretionary division. again, as Fergus touched on earlier, that might be more akin to a sort of full equity model, or you might see a line of members' remuneration charged as expense, which effectively shows typically more sort of fixed share partners where there is an automatic division. So that's the P&L, and there's all sorts of interesting ratios that you can play around with in terms of operating margin and turnover to headcount. There's a really good snapshot as to the firm's performance over the year. And conversely, the balance sheet is a sort of it's a snapshot at a point in time rather than reflecting annual performance. I think that there are a number of kind of key things that you want to be mindful of coming into the firm in terms of understanding the balance sheet. We'll come back to cash, but cash is clearly king. So focusing on the ability of the firm to convert its work into invoices, clear through debtors and WIP, and reduce the lockup and end up in cash is critical. And I also think it's really interesting to try and understand and get your head around how specifically your firm accounts for work in progress or accrued income, or indeed amounts recoverable on contract. When I use these terms, I'm really talking about open cases at balance sheet date. And there's a value ascribed to these. If matters are contingent, sometimes it's nil. Sometimes cases are valued at the lower of cost and net realisable value, other times at full realisable value. So do poke around work in progress and try and get your head around the way the firm has accounted for that. It's a judgmental area and always something that crops up on an audit. So pay attention to debtors, pay attention to WIP. Also take a look at the gearing of the firm in terms of debt and required repayments for the year ahead. Clearly in choppy waters as a result of the COVID situation. So do take a look and understand what the firm's obligations are as you buy in. The other interesting statement that I think I'll just touch on is the statement of members' interests, which is effectively the full movement of transactions with partners, so owners of the business during the year. Again, typically you might see capital coming in and out. You'll also see your profit number flowing through onto the balance sheet, offset against any drawings, so cash taken out of the business. And also take a look at drawings in the context of partners tax reserving, because the cash flow movement is washed through there. Again, something that Ian will no doubt touch on a little bit later. The accounting policies are also critical in terms of understanding your LLP financial statements, and they talk around some of the judgments that the members would have made in preparing the financial statements, such as things like provisions for claims and liabilities, typically a judgmental area. Might talk about provision for trade debtors and bad debts on disbursements. And again, it's very, very common indeed to see a policy covering the judgments applied in arriving at your work in progress or accrued income valuation. So typically those are the types of things you might see. And again, in this current economic situation, the going concern policy, again, really important to get your heads around that and to understand the steps that the firm has taken to protect itself and to ensure that it can trade for a period of 12 months following the approval of the financial statement. So again, we're seeing lots of enhanced policies around going concern, as well as indeed some emphasis on matter paragraphs in the audit report itself. So it's testing times. And then again, appreciating that the accounts can be long and lengthy, do also scour through the notes. You get lots of interesting information in the notes. Again, you can play around with ratios on head counts and get things like that. You'll also have the typically average members' remuneration disclosed, as have the key management personnel also, and indeed actually the highest paid member is also a statutory disclosure, although possibly not as a new partner, but in time. Ian, would you pop on to the next slide, please? So we talked a bit there about the sort of outward-looking accounts that indeed may go on public record as an LLP if you've been audited. I also think it's really important to get to grips with your own internal KPIs as a new partner and what's expected of you in terms of performance. I'd certainly encourage, again, within the strictures of how the firm is run, I'd encourage a conversation with your sort of CFO or finance partner, as far as it's practical, to really get to grips with wider departments and departments outside of your own, to understand what's making the business tick. You know, things like chargeable hours, things like lockup, really, really important. And again, we come back to this theme of cash being king, and that lockup process of doing the work, hitting the code, getting the bill out and cash in the door. Have a good grasp of how long that process takes, and anything you can do to make that process more efficient will clearly lead to a more profitable firm and place to be. I think we've touched on the importance of revenue recognition and what's coming onto your balance sheet at the year end and how that's calculated. Again, really important to get your heads around, as well as your own capital position and the situation on retirement or an exit. What happens to that capital that's been wrapped up? I mean, typically we're seeing more and more firms presenting that as a loan on the basis that it is actually sort of repayable on exit. But again, important to go back to the agreement and to make sure the accounts are reflective of your situation. Ian, final slide, please. So we've talked through some accounting policies, we've talked through the notes and what I would call the top half of the balance sheet. Of course, as owners of a professional services firm, your stake is effectively in the bottom, so to speak. What you'll see is you'll have reserves, the tax, you'll have your current account reflecting your allocation and drawings coming in and out, and your capital accounts. And these will be amalgamated under various statutory headings in your financial statements. And again, actually, without meaning to steal any of Ian's thunder, really important to understand how tax is accounted for, whether it's deducted at source, whether it's wrapped up into the LLP's working capital cycle. Again, pretty topical at the moment, given some of the current challenges around cash. So look, that was a very whistle-stop tour, but do please feel free to reach out to me if you'd like to discuss any of these in a little more detail, or indeed ask a question as we go. Thank you. I'll hand over now to Ian.
That's great. Thanks, Hal. I will be talking you through some of the main tax considerations for new self-employed partners. My agenda for today is to discuss some of the initial actions required by new partners, to briefly explain how taxable profits are calculated from accounting profits, provide an overview of your assessable profits, the content of your yearly tax return, and then also the timing of your tax payments. So moving on to initial actions. New partners need to notify HMRC of their self-employment using the form SA 401 as soon as possible after they've commenced, and certainly by 5th of October following the end of the tax year in which their self-employment commences. And the submission of this form ensures that HMRC are aware of your self-employment and that Class 2 NICs can be collected. And then following registration as self-employed, you'll then be within the self-assessment regime, and you'll need to submit a yearly tax return to HMRC, which I'll talk a little bit about later. New partners are often required to inject capital into the partnership. Such capital could be contributed from both the partner's own funds, by way of a partnership bank loan, or it could even be a mixture of both. Typically, though, we see partners inject capital by way of a bank loan, and tax relief is available for any loan interest which is paid, and that's relieved at your marginal income tax rate. It's also worth mentioning that as a result of anti-avoidance legislation, there are some specific rules for partners in LLPs in order that they can be taxed as self-employed individuals. And one of these rules are that new partners in LLPs may need to inject capital of at least 25% of their fixed profit shares within 2 months of commencement in order to be taxed and treated as a self-employed individual. And the failure to meet this requirement could result in partners being taxed as if they're an employee. It's also important that as a new partner, you need to know whether your firm has a tax reserving policy, which was obviously something Hal mentioned earlier. And if so, your firm may retain from monthly drawings and any bonus payments the anticipated tax liabilities due on this income, and then subsequently making payments to you net of these expected liabilities. The retentions are then held by your firm in order to settle your partnership tax liabilities, but it's also important to mention that the retentions may not be sufficient to sort of settle any personal tax liabilities. So if there isn't a tax reserving policy, in which case the partners need to retain funds to meet the expected future tax liabilities, worth mentioning that depending on joining dates, the first tax payment to be made to HMRC could be up to 21 months after becoming a partner. And I'll be illustrating this with a slide later on. We often are asked by our clients to help them calculate the tax reserves, which need to be retained on their partnership and or personal liabilities, so there's no nasty surprises when tax liabilities are paid to HMRC. And Tim will be discussing cash flow considerations for partners in relation to the tax payments in his section of the webinar. So moving on now to taxable and assessable profits. Hal mentioned earlier about the contents of the partnership's accounts, and the net profit is the starting point for us in the calculation of the partnership's taxable profits. Partners are taxed on their share of the taxable profits, and so a calculation is needed to translate accounting profits into taxable profits. And it's a partner share of the taxable profits, which are very different to a partner share of accounting profits or monthly distributions received. So in order to arrive at taxable profits, partners will be allocated a share in the various tax adjustments identified in the partnership tax computation. And those tax adjustments could, for example, be add-backs for depreciation and client entertaining, and deductions for capital allowances. And these adjustments often result in taxable profits being higher than accounting profits. So now that we've identified how taxable profits for accounting period are calculated, we can calculate how those profits are subject to tax. So for partners in partnerships with a 31st March year end, the position is relatively simple. 31st March year end is treated as coterminous with the 5th of April tax year end. And in year one, partners are taxed on their share of the taxable profits from the date of joining, which is the 1st of April 2020 in this slide, to 31st March 2021. And then in year two, partners are taxed on their share of the taxable profits for the 12 months ending in that tax year, which is 31st March 2022 in this slide. And so that continues. But what is the position for partners in partnerships with non-31st March year ends? So the position becomes more complex where the accounting date is not 31st March. And in this example, you'll see that the partner joins on 1st of May and the partnership has a 30th of April year end. In year one, partners are taxed on their share of the taxable profits from joining, which is 1st of May 2020 to 5th of April 2021. Year two, partners are taxed on their share of the taxable profits for the year ended 30th of April 2021. And then in year three, partners are taxed on their share of the taxable profits for the year ended 30th of April 2022. So I think in this example, you can see that the basis periods for years 1 and 2 will reflect the impact of COVID-19 on the profits, and just bear in mind that these could reflect lower than your expected profits. Another point to mention from this slide is that you'll see that the profits for the period May 20 through to 5th of April 2021 are being taxed twice, firstly in year one and then again in year two. And these profits are known as overlap profits. So what are overlap profits? Well, following on from the previous slide, the overlap profits are for the period 1st of May 2020 to 5th of April 2021. And these are calculated to be 110,000, which are simply 11/12 of the taxable profits for the year ended 30th of April 2021. These overlap profits are relieved typically when a partner retires from the partnership, or perhaps on a change of accounting date, which may be being considered as a result of COVID-19. An illustration of the calculation of taxable profits on cessation or on a change of accounting date are outside the scope of this webinar. But I think it's important to note that ultimately, over the course of being in a partnership, a partner will only be taxed on the taxable profits that they've earned. So now that we've identified a partner's taxable profits, how do you pay tax on these? So first of all, you need to prepare a self-assessment tax return. And in order to calculate your tax liability, this form needs to be completed, which reports all of your income, gains, and claims for qualifying reliefs for the year. Your income will include, but not limited to, your taxable partnership profits, any employment income received in the year in which you joined, any investment income, and any capital gains from the disposal of chargeable assets. Qualifying tax reliefs could include pension contributions and charitable gift aid donations. And from this information, the tax return will then calculate your total tax and national insurance liability for the year, together with any payments on account due for the following tax year. And important to note that the tax return is due for submission to HMRC by 31st January following the end of the tax year. And failure to submit this form on time will result in penalties being levied by HMRC. So moving on to my final slide on tax liabilities and tax payments. The normal due dates for payments to HMRC are 31st of January and 31st of July. The timing of the first tax payment to HMRC by a new partner is the 31st of January following the end of the tax year in which they became a partner. And this is illustrated in my following slide. In this, you can see that the partner joined on 1st of May 2020, and the first tax payment is due to HMRC on the 31st of January 2022. And this is a period of 21 months later. The tax payment due on 31st January 2022 is the tax payable for the year ended 5th of April 2021, and the first payment on account due for the year ending 5th of April 2022. And that payment on account is based on 50% of the income tax and class 4 national insurance liability for the previous tax year. The second payment on account is then payable in July 2022, and any balancing payment for the year ending 5th of April 2022 is payable in January 2023. And so this payment mechanism typically continues each year. However, it's just worth mentioning that where a partner's tax liability is expected to reduce, for example, as a result of a reduction in profits, which could of course be as a result of COVID-19 issues, a reduction in personal income or income in tax reliefs, it's possible to reduce the payments on account to a much more realistic level. So that concludes the tax section of my webinar, and I'll now pass you over to our second guest speaker, Tim Erlam of Brewin Dolphin, to discuss some of the financial implications of becoming a partner.
Thank you very much, Ian, and good afternoon, everyone. My name is Tim Erlam. I'm a wealth manager at Brewin Dolphin in our London office. The aim of the next few slides is to take you through the 6 topics highlighted on the right of your slides, which are areas that we think should be kept in mind when going through that transition and becoming a partner, but more from a financial planning perspective, so thinking about your own sort of personal finances and how to structure those. So if we could go to our next slide, please, Ian. Thank you very much. So restrictions on pensions. This sort of revolves around the concept of the annual allowance. Now, the annual allowance is the total gross amount that both you and your employer or partnership are allowed to pay into a pension in any one tax year. And it's currently capped at £40,000 gross per tax year. Now, there is an additional piece of legislation called the tapered annual allowance that means that people who earn over £240,000 a year will be subject to a reduced annual allowance. And the way that this works is that if you earn over £240,000, for every £2 over that amount that you earn, you lose £1 of annual allowance. Now, the lowest your annual allowance can go down to is £4,000. So therefore, once you're earning over £312,000 a year, your annual allowance will be £4,000, regardless of how much above that you may earn. But the fact is, and the point we need to keep in mind, is that once you're earning over 240, you're no longer going to be subject to the normal £40,000 annual allowance each year. The reason this is relevant here is that quite often when being made up as a partner, you will experience a significant pay rise, which obviously is fantastic. You just need to keep in mind that if your pension contributions remain unchecked and you continue paying in the same amount as you were pre-partner, it might be that your earnings have moved you from a position where you weren't subject to the tapered annual allowance to somewhere where you are. And therefore, you may now be paying in, or the combination of your contributions and those of your employer / the partnership are taking you over your tapered annual allowance. You will end up with an unwanted tax charge. Now, the way that this works is that any excess that is paid into your pension will be subject to an income tax charge at your highest marginal rate. So not an ideal situation that one wants to find themselves in. So the sort of the takeaway message is when you are promoted and you become a partner, and if your earnings fall into that bracket of being over £240,000, you need to find out what your tapered annual allowance is and just make sure that you're not going over that. The other element to bear in mind is that if you've gone through the motions of finding this out and you discover that you do have a tapered annual allowance and you're unable to pay in the same amount of pension contribution that you're paying in previous years, you're not going to be getting the same level of income tax relief that you were before. So therefore, your income tax position isn't going to be quite as efficient as it was before. And so therefore, it might be worth thinking about what your alternatives are, which is something we'll cover in a later slide. If we go to the next slide, please, Ian. So alternative benefits. So if you've gone through the motions of double checking whether you have got a tapered annual allowance, and if it turns out that you are subject to it, and part of your sort of contract as a partner was that you were going to receive contributions from your employer or the partnership, the reality is that if they were paying in, say, for example, £20,000 in previous years, and now they're unable to because of the tapered annual allowance, it means that your overall remuneration structure that you're receiving from them will go down unless they offer something else with a similar monetary value. So this is more a point to keep in mind, to speak to HR about, and just raise the issue of, well, what happens to me if my earnings go above this level and I can no longer have money paid into my pension? How else am I going to be remunerated to make things good? And the question, the reality is that obviously all partnerships and firms will have a different answer to this. Some may just simply say, well, I'm very sorry, you're earning this amount and you can't have any money paid into your pension, so therefore that's, there is no alternative. However, some may say, simplistically, they may say, well, the money that we were previously paying into your pension that we no longer can, we will add it onto your gross earnings each year and you'll receive the benefit in that shape. Now, the point to sort of keep in mind is obviously that's good in that they're trying to show some flexibility in making sure that your remuneration package doesn't suffer because of this reduced annual allowance. But the reality is, and what you need to think about, is that if they were to just stick it on top of your gross earnings, and the fact is that's going to then be subject to income tax and national insurance. So the net benefit to you, i.e. what ends up in your bank account, may not be the same as how much it would have been if it had gone through a pension contribution. So I think taking a step back from sort of the minutiae of it, it's think about, okay, well, am I going to be affected by this? If I am, what are the alternatives? And then when you look through the alternatives, think about what's actually going to be the net benefit for me of the various ones, and thinking about what's the best option to go for. If we go to our next slide, please, Ian. So alternative investments. Now, this is again following on the theme of pensions not being a possibility anymore. So thinking about, okay, well, what else should I be doing with the money that I was putting into my pensions each year? What we've done here is highlight three of the sort of main benefits of having a pension. And what we encourage clients to do is think, well, if pensions are no longer an option for me, which of these three elements are the ones that I want to prioritize? So is it that I was very, very, focused on the income tax relief that I got, and I want to maximize tax relief that I can get to make my overall tax position as efficient as possible? Or was it an investment-driven decision where you thought, well, actually, I like the fact that pensions aren't subject to income and capital gains tax, and so I want to try and recreate that with the substitute. So it's thinking about which one of those is a priority for you and finding the correct investment vehicle to invest in. Now, obviously, this is something that we can advise on, and it's not that all three are mutually exclusive. There are options that will tick 1, 2, or 3 of these boxes. But it's finding out which one fits with your broader circumstances and also which one ticks the boxes for what you're prioritising with your regular saving. Okay, if we go to our next slide, please, Ian. So cash flow. This is following on from what Ian was discussing in the section previous to this, whereby you're no longer going to be paid via PAYE, and you're now a self-employed partner, which means you're making payments on account every January and July. So what I'm about to say isn't hugely relevant if your partnership offers or operates a tax reserve policy, because obviously that means that more often than not you will have the money there available to pay your tax bills. But if they don't, then you need to be aware of the fact that obviously you need to have this money available to pay. So if you're someone that after you've paid all your bills and you've allocated your money for spends, anything that's left over just sits in a bank account and that's your savings, then that's fine, because obviously you have cash that's readily available to you to pay the tax bill as and when they arise. However, if you're someone that rather than just puts it into a bank account and leaves it there, you're thinking, okay, I want to put this into my ISAs, I want to put this into a VCT, I want to put it into an offshore bond, various other investments that are available to you. If you're putting it into those, it's encouraging you to think, okay, well now I need to be aware that actually all my excess income, if it's going to these investments, it needs to be accessible. And you need to think, well, 1, can I access it? 2, what are the tax implications of accessing this money if it is in various investment structures? And then 3, you need to think, well, within these investment structures also, if I'm looking to raise cash, which of the investments inside there should I be selling? You have to think about it from a tax planning perspective, but also from an investment perspective. Should it be that I'm selling my European equities down, or is it I should be selling some of my fixed interest allocation? It's that kind of level of detail that you need to think about. And so it's just making you aware that things aren't quite as simple anymore with regards to saving and investing your money, because the fact is you need to have some available to settle these tax bills. If you go to our next slide, please, Ian. So changes in benefits package. This is with regard to things like life insurance and income protection, private healthcare and the like. It's not to say that when you become a partner, you're going to receive a wider range of benefits. I mean, that may happen, but what I'm highlighting here is you need to think about, well, does the level of life cover, or death in service as sometimes it's called, does that level of cover change? Does my level of income protection change? But then we encourage clients to think, well, how does that fit with what my actual financial circumstances are? The thing with cover and sort of protection and sort of insurance and all those sorts of things is that they aren't a one-size-fits-all product. It needs to be tailored to what your individual circumstances are. So it's what I'm encouraging clients to do in this situation when you're becoming a partner is look at what cover you're going to be provided and then sort of overlay that with what your financial situation is. So it might be that actually you've got mortgages on your main home, on a buy-to-let property, you've got children going through private education who will be there for the next decade or longer. And the cover that you're provided, should something happen to you and either you're not around or you're unable to work, it could be that the cover that you've got available isn't going to be enough to settle all those requirements, and it will mean sort of an upheaval of the family situation. And so it's all about thinking, well, what actually do I need, and making sure that any gaps that exist between what the partnership provides and what you require is, these gaps are plugged. And then the other thing to highlight is that quite often we see that when people become partners, there is the option to increase your life cover for a disproportionately small extra premium. So this is something that, again, it will come down to affordability and whether it's actually required or not. But it's worth looking through your partnership agreement, looking through what the contract says with regards to these benefits, because if in reality it is affordable, it's quite often it's worth doing, because it will make quite a dramatic difference to your family that are left behind. Obviously, it's a very morbid topic to cover, and like most insurance, it's one of those things that you're paying for that you hope to never actually use. But the reality is that if something were to happen, if you've paid for this extra level of cover, then you could end up or your family will be left in a significantly better position financially than they were before. If you go to the next slide, please, Ian. Okay, this is my final slide, and it's with this regulatory concerns is with regards to sort of trading and dealing. So when you become a partner, it's quite often you're deemed to be or have access to information that you previously weren't privy to. And so therefore, from a regulatory perspective, there are restrictions on how you trade and what you can trade in. So it's more to do with sort of investment trusts, equities, things that are listed. And it's not to say that when you become a partner, your investment propositions are scuppered and you have to think about a different way to invest your money. It's just we need you, or you need to think more about what your arrangement is with regards to your investments. So the final bullet point highlights advisory versus discretionary. Now, the reason this is important is because if we start with the latter, a discretionary investment management offering is where, in essence, you hand over the cash that you want to invest to an investment manager, and you agree your risk profile, whether you want growth, whether you want income, what level of risk you want to take, how long you want to be investing for. But the investment manager is free to deal as they see fit. Therefore, there's sort of that arm's length element to it, whereby you're not having any direction or steer on what investments are sold and bought. And so from a regulatory perspective and an internal compliance perspective, it's fine, because even if you have access to that information, you're not steering your investment manager to buy and sell certain things. Whereas if you've gone down the advisory route, the way that relationship works is that whilst you agree risk and time horizon and similar things that you agree with a discretionary offering, when it comes to actually trading, anything that is sold and bought, there is formal advice written to say, I recommend you sell X and buy Y, and you have to agree to it. So therefore, you're sort of having sign-off to say, yes, I want to proceed with trading in these holdings. And if that's the setup that you have, then every time you trade, you need to run that past your internal compliance department to make sure that they're okay with it, and that there's nothing that's sort of, from a regulatory perspective, that's going to be have a negative effect. So it's not to say that either route one is appropriate and one isn't, but it's very much, you have to think, well, actually, have I got the time and the inclination to be agreeing to all the trades that I'm placing, and then also having to deal with internal compliance about getting it signed off. Some people prefer that. Some people like to have the insight into what trading is being done and having that final say. But sometimes, and a lot of people will just think, well, do you know what? I'm going to leave it to the people who are the experts. I don't need to know all the trades that are going on, and I don't want to have to continually speak to compliance about what deals are being made. And so it's more, as I said, it's not to say that you can't do one route or the other. It's just encouraging you to think, well, actually, what sort of relationship do I want to have, and how that will be affected when you become a partner. So that's been a fairly whirlwind journey through 6 elements that we think are worthwhile considerations when becoming a partner from a financial planning perspective. I believe there will be questions and answers later on, so if you have got any questions, then please just ask, and then I'll pass you back to Mark.
Thanks, Tim. That's very helpful. In fact, thank you to all the speakers. A smooth handover, just like a Great British Athletics 100-meter relay team. That's brilliant. We do have a couple of questions. I actually had some questions of my own, but let's go through some of the questions that's been raised. No particular order, but Fergus, if you're still on the line, one of the questions we've got is, how have you seen partners' rights change over the last couple of years?
Thanks, Mark. I suppose, and maybe in truth, this probably began more than a couple of years ago, something of a cliche, but there's been a long-trailed trend towards firms becoming far more corporate in their management. The consequences, sort of rights of partners in decision-making, sort of being removed up a level to a smaller group of often partners, and sometimes external people coming in, finance roles and so on, and that possibly has a knockdown effect, so that the more junior partners, fixed-share members, may find that ultimately their kind of say in how the business is managed is reduced. Now, it's particularly the case in larger organisations. I mean, just a small thing, I suppose, at a micro level, going the other way, as I touched on, I think for certainly the more enlightened firms are trying to address things like family leave and flexible working, just to really reflect the modern world, about how people do want to spend time with young families. And I think that's probably going to be an increasing trend. and dare I say, challenge firms to manage that.
Thank you. I've got a couple of questions which clearly are aimed at Hal, so I'm just conscious of the time, so I'm just going to pick one of them, which I think is probably the most interesting, Hal.
Sure.
If I paraphrase a little bit, but what's the direction of travel in terms of LLP reporting when we look at ethnicity and gender pay gap reporting?
Yeah, really good question. I think the fact it's been asked, I think is probably indicative of sort of general shifts in LLP and other financial statements to sort of broader issues. So just at the moment, we're actually going through a phase of seeing our first energy and carbon reporting for larger entities. So kind of looking at the sort of environmental impact of businesses. So actually, you're right. I think that the direction of travel will be one that takes into account and that documents on record and in financial statements things around gender pay and diversity.
Thank you. The ethnicity report, that's in consultation now, is it, at the moment?
Yeah, working through.
Yeah, okay. Thank you. I mean, I've got a couple for you, but let's spread the love. But so Ian, I've got one here. It says it's talking about actually they joined a couple of years ago. So it says I'll read it straight out. I joined my partnership in 2018-19 tax year, made payments on account to HMRC for 19-20 in January based on previous year's profits, as we know from your examples. He goes on to say, he or she, my taxable profits for 19-20 are expected to be lower due to the COVID-19. What are the options available to me the coming July payment on account?
Hi, Mark. Yeah, that's thanks for the question. So in that scenario, I think there's a couple of options which would be available. Obviously, it would depend on the basis period for the 19-20 tax year and the individual's personal circumstances. But where there's a reduction in profits, I would expect there to be a possibility to reduce the payments on account due. And in this particular scenario that you've set out, I would certainly recommend a calculation of the expected tax liability for the 19-20 tax year. And if the overall liability is less than the required payments on account due, to make a claim to HMRC to reduce the payments on account due, and that would certainly help with cash flow.
Yeah. I guess we also got the COVID-19 relief as well.
Yeah, absolutely. That's the sort of second option that would be available, and it's possible to reduce the July. To the July 2020 payment for up to 6 months. Now, no interest would be charged in that scenario. Although it is probably worth mentioning that HMRC have said that you should pay that July tax payment if you are able to do so. But an important point probably to mention as well is that if your partnership holds a tax reserve for you, probably worth having a discussion with them about that July payment on account, because ultimately the tax reserve funds are your funds, and in the event that the partnership didn't have that sort of tax reserve available to pay the tax liability 6 months down the line in January 2021, the revenue will still come after you for that payment. So well worth discussing with your partnership, and yeah, they're the options available, I think.
That's a really good point. I mean, I guess the other point to bear in mind is if you were made up to a partner last year, which has a sort of slightly different context to it, using your example, basic periods, I mean, you could be taxed on two tax years on one good year, even though your second actual year could be considerably affected by COVID-19. So again, another good conversation to have with the finance director. I think we probably I don't know whether we can squeeze. We got 6 minutes. Perhaps we can just squeeze one quick more question. Perhaps Tim, if you're still on the line, you've covered one of the areas already about tax relief on investments and alternatives to pensions. So perhaps I can pick the other question, which is how does tapering of the annual allowance interact with the ability to use carried forward pension contributions? Just a couple of minutes to answer that nice one.
Yeah, that's fine. I'll do my best to do it quickly. So essentially, what's been raised here is within pension legislation, you're able to carry forward any unused pension contributions from the previous 3 years into the current year. So essentially, it means that if you've not contributed the full 40,000 in the previous 3 years, you can then carry that forward and pay it into the current year. Now, the taper obviously affects what you can pay in, and I think what the question is asking is that how does the taper affect the previous tax years? Now, it's a slightly complex one in that, one, for starters, you have to look at what your earnings were in those previous 3 tax years, and two, the taper annual allowance existed in those 3 tax years, but just to make the situation even more complex, is that the rules on the tapered annual allowance, well, rather the thresholds for the tapered annual allowance were slightly different. So I think, in answer, yes, the tapered annual allowance does affect the previous 3 tax years when you're looking to carry forward for a pension contribution, and extra attention needs to be paid with regards to figuring out how much that is, because there were tapered annual allowance rules in there, and the limits, or rather the thresholds, as I said, were slightly different to what they are now. So hopefully that answers it, but I think it's a conversation that perhaps warrants a bit more than a couple of minutes. So if anyone wants to get in contact about that, then that's fine.
I think it does, and thank you for trying to squeeze it in, yeah, but clearly one that advice is definitely recommended. I think we've probably not got time for any more questions, so I apologise if we haven't answered your questions, and we will try to send an email out to those to cover those unanswered questions. Ordinarily, I'd ask you to give us sort of a virtual round of applause for the speakers, which is Fergus Payne, Hywel Pegler, Ian Ratcliff, Tim Erlam. Thank you very much for your time, gentlemen, and hopefully we will see you again next year. And thank you everyone for participating and joining and listening. I hope you found it helpful, and we look forward to hearing from you soon. Thank you very much.